A senior vice president at a regional bank in Minneapolis named Richard opened his first paycheck of 2026 on a Friday morning in early January and noticed something was wrong. He was 62 years old, 28 years at the bank, 3 years from his planned retirement, and for the past 12 years he had been making the maximum catch-up contribution to his 401k plan every single year. He had penciled in $7,500 in catch-up contributions for 2026 on top of the standard $23,500 limit, all of it pre-tax, all of it deducting against his 32% federal bracket and his 9.85% Minnesota bracket, just as he had always done. Except his paycheck stub did not match the math he had been doing in his head for a decade. The catch-up contribution had been processed, but it had not gone into his pre-tax bucket. It had been routed into the Roth side of his 401k plan, and there was no federal or state tax deduction attached to it. The line item that had been quietly saving him roughly $3,300 in federal income tax every year, plus another $740 in state tax, was gone. Vanished. His payroll office had not made a mistake. The plan administrator had not made a clerical error. The change was the law. It had taken effect on January 1st of 2026. And Richard, who had read his benefit summary every fall for 28 years, had no idea it was coming. The entire compliance workshop his employer had run in November had not mentioned it once. His financial advisor had not mentioned it at the December tax planning meeting. The only piece of paper he had received was a single line in a 4-page plan amendment notice that he had filed without opening. Same paycheck, same job, same catch-up election. Roughly $4,000 in additional federal and state taxes that he had not budgeted for. And the change Richard discovered on a Friday morning in January is the same change blindsiding hundreds of thousands of workers age 50 and over across the country right now. Here is what happened. And here is exactly how you make sure it never happens to you. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me walk you through what changed and why, because once you understand how the rule was written, you will see exactly which workers it hits and which workers it leaves alone. The Secure 2.0 Act, which Congress passed at the end of 2022, contained a provision called Section 603, the Roth catch-up mandate. Under prior law, anyone age 50 or older participating in an employer 401k, 403b, or governmental 457b plan could make a catch-up contribution above the standard contribution limit, and that catch-up could be made pre-tax just like the rest of the contribution. Section 603 changed that for one specific group of workers. Starting in 2026, if you are age 50 or older and your prior year FICA wages from the employer sponsoring the plan exceeded $145,000, your catch-up contribution can no longer go in pre-tax. It must go into a Roth account with after-tax dollars. The standard contribution below the catch-up threshold is unaffected. You can still put $23,500 or whatever the index limit is into the pre-tax bucket. But the catch-up portion on top of that is now mandatorily Roth for high earners. The rule was originally scheduled to take effect on January 1st of 2024. The Internal Revenue Service issued a 2-year administrative transition period in 2023 that pushed full enforcement to January 1st of 2026. That delay is now over. The rule is live. As of this filming, your plan administrator is either complying or out of compliance, and either way, the impact on your paycheck and your tax bill is real. Now let me put a number on this so you understand the stakes. Scenario 1. Richard, the bank vice president in Minneapolis, age 62, prior year FICA wages of $240,000. Standard 401k contribution limit in 2026 is $23,500. The basic catch-up for age 50 and over in 2026 is $7,500. Now here's the part most people do not know. Under Section 109 of the Secure 2.0 Act, there is a higher catch-up amount for workers ages 60 through 63, often called the super catch-up. For 2026, the super catch-up is the greater of $10,000 or 150% of the regular catch-up, which works out to approximately $11,250. Richard, at age 62, is in the super catch-up window, so his maximum catch-up in 2026 is $11,250. Under prior law, all $11,250 would have gone in pre-tax, deducting against his 32% federal bracket and his 9.85% Minnesota bracket, for a combined marginal rate of roughly 41.85%. That deduction was worth approximately $4,700 in tax savings every year. Under the new rule, the entire catch-up must be Roth. Richard pays the $4,700 in tax this year. He gets tax-free growth on that money in retirement, which is real and meaningful, but he does not get the upfront deduction. Same job, same election, same dollar contribution. Roughly $4,700 tax hit he did not see coming. Scenario 2. A federal employee in Virginia named Linda, age 56, career civil servant at a defense agency. Prior year FICA wages of $138,000. Linda contributes the maximum to her thrift savings plan and adds the $7,500 age 50 catch-up. Now here is the critical detail most workers miss. The $145,000 threshold is FICA wages from the employer sponsoring the plan, not adjusted gross income, not taxable income, not total household income. Linda's prior year FICA wages were $138,000. She is below the threshold. Her catch-up contribution can still go in pre-tax in 2026. The new mandate does not apply to her. Her husband, who runs a small consulting practice on the side, brought their household income above $200,000. That does not matter. Linda's spouse's income is irrelevant. What matters is her FICA wages from the agency that sponsors the thrift savings plan. Linda contributes pre-tax just like she did last year. The Internal Revenue Service does not care what the household earned. They care what the W-2 from the plan sponsor reads in Box 3 for FICA wages. Scenario 3. A senior software engineer in California named David, age 58, total compensation of $350,000 at a publicly traded technology company. He left that employer in March of 2025 and joined a smaller competitor in April. His FICA wages from the prior employer for 2025 were $168,000. His FICA wages from the new employer for 2025, covering only 9 months of work at a similar pay rate, were $165,000. Now in 2026, David is participating in the new employer's 401k plan. The Roth catch-up mandate looks at FICA wages from the employer sponsoring the plan in the prior year. The new employer's plan sponsor only paid him $165,000 in 2025. That is above the threshold. David's catch-up at the new employer must go in Roth. But here is where it gets interesting. If David had switched to a smaller employer where his prior year FICA wages from that specific plan sponsor totaled less than $145,000, say a part-time consulting role or a position with a substantial unpaid leave in the prior year that pushed FICA wages below the threshold, his catch-up at that new employer could go pre-tax. The mandate is calculated employer by employer, plan year by plan year. There is a separate employer mechanic that some workers can use intentionally, particularly highly compensated employees who are also self-employed. If you have a side business that sponsors its own solo 401k, the FICA wages from your day job do not count against the solo plan. The threshold resets per employer. Scenario 4. A small business owner in Texas named Susan, age 60. Prior year FICA wages from her S corporation, which sponsors the company's 401k plan, of $170,000. She is in the super catch-up window. Her catch-up at the company plan must be Roth. Now here is the part that changes everything. Susan also operates a separate consulting practice as a sole proprietor and has established a solo 401k for that business. The solo 401k is a separate plan sponsored by a separate employer, even though both employers are her. The solo plan does not look at her S corporation FICA wages. It looks at her self-employment net earnings from the consulting practice, which were $38,000 in the prior year. $38,000 is below the $145,000 threshold. Susan's catch-up at the solo 401k can go pre-tax. So Susan splits her contributions strategically. She does the standard contribution at the S corporation plan because the employer match is meaningful. She funnels her catch-up dollars into the solo 401k where she can still get the pre-tax deduction. Same person, same household, same overall income. The structure preserves the pre-tax catch-up that the mandate was designed to take away. Now here is where it gets critical. There is a plan amendment compliance issue that may delay enforcement at some employers, and you need to know how to read your plan documents this year. The Internal Revenue Service released final regulations on the Roth catch-up mandate in 2025. Plan sponsors had to adopt amendments to their 401k, 403b, and 457b plan documents reflecting the new rule. Many large employers amended their plans by the deadline. Some smaller employers, governmental plans, and union bargain plans received additional time, in some cases through the end of 2026 or beyond, to formally amend the plan document language. During that interim period, the operational rule still applies. Your contributions still must be processed correctly. But there are documented cases of plan administrators being out of compliance during the transition because they had not received clear instructions from human resources or had not finished updating their payroll system. If you walk into the new year and your catch-up contribution is still being processed pre-tax, even though you earned more than $145,000 in FICA wages last year, you are not in the clear. The Internal Revenue Service is going to want corrective action when they catch it. The plan may have to recharacterize your contribution or distribute it. You could face a corrective distribution and a $199.99 penalty, depending on how the situation is resolved. Do not assume that silence from your payroll office means your election is correct. Verify it. Here is your action checklist, and I want you to take this seriously because your employer's Human Resources Department is not going to call you. Number 1, look at the box 3 line on your 2025 W-2. That is the Social Security wages line. That is the number the rule looks at to determine whether you cross the $145,000 threshold. Not box 1 wages, which are reduced for pre-tax retirement contributions, not adjusted gross income from your tax return. Box 3. If box 3 exceeds $145,000 and you are age 50 or older, your 2026 catch-up at that employer must go in Roth. Number 2, log into your 401k participant portal and look at your catch-up election. If your plan offers both pre-tax and Roth contribution buckets, the catch-up should now be flowing into the Roth bucket if you are above the threshold. If it is not, contact the plan administrator immediately. Number 3, if you are between ages 60 and 63, you qualify for the super catch-up. Make sure your contribution rate is high enough to capture the additional roughly $3,750 of contribution room that age band gives you. The super catch-up phases out when you turn 64. At age 64 and beyond, you go back to the regular age 50 catch-up amount. So if you are 60, 61, 62, or 63 this year, this is a 4-year window. Use it. Number 4, If you are slightly above the $145,000 threshold, and you have flexibility on year-end timing of variable compensation, bonuses, deferred commissions, equity vesting, talk to your tax preparer in October or November about whether the timing of those payments could push your FICA wages below the threshold for the following year. The $145,000 is indexed for inflation in future years, so the target moves slightly. Number 5. If you operate a side business or have self-employment income that could support a solo 401k, explore whether splitting catch-up contributions between two separately sponsored plans makes sense. The threshold is plan sponsor by plan sponsor. A solo 401k for a sole proprietorship looks at net self-employment earnings, not at your day job W-2. Number 6. Recalculate your projected federal and state tax bill for 2026, assuming the catch-up portion is no longer deductible. For a high bracket worker, this can be a $3,000 to $5,000 swing. Adjust your federal withholding on Form W-4 and your state withholding accordingly. Do not wait until April of 2027 to discover you owe more than you expected. Number 7. Evaluate whether the Roth catch-up is actually a problem for your overall plan. For workers in their early 60s, with 3 to 5 years until retirement, paying tax on the catch-up at 32% today and getting tax-free growth and withdrawals on that money for the next 25 years is a calculation you should run with a qualified planner. The forced Roth treatment is not always bad. It can be a hidden long-term win for the right household. But you have to know what your effective bracket in retirement is going to be to make that call. Number 8, request a copy of your plan's amendment regarding Section 603 of the Secure 2.0 Act in writing from your Human Resources Department. Confirm that your specific plan is in compliance. Confirm that the payroll system is processing catch-up contributions correctly given your prior year FICA wages. If your plan administrator cannot produce that documentation, escalate. Number 9, if you discover a misclassification of contributions in the first quarter of the year, request a correction immediately. The Internal Revenue Service Employee Plans Compliance Resolution System under Revenue Procedure 2021-30 allows for self-correction of operational failures within a defined window. Catching a mistake in February is a one-page memo. Catching it in November is a multi-$1,000 correction with potential excise tax exposure. Same paycheck, same job, same catch-up election. Richard in Minneapolis lost approximately $4,700 in combined federal and state tax savings in a single year because nobody walked him through Section 603 of the Secure 2.0 Act. Linda in Virginia kept her pre-tax catch-up because her FICA wages from her plan sponsoring employer happened to fall below $145,000. Susan in Texas restructured her catch-up across two separate employer-sponsored plans and preserved pre-tax treatment on the dollars she could route through her solo 401k. The difference between these outcomes is not luck. It is not a loophole. It is Section 603 of the Secure 2.0 Act of 2022, made effective January 1st of 2026. The law is real. The threshold is $145,000 in FICA wages from the plan sponsoring employer in the prior year indexed forward. The super catch-up window for ages 60 through 63 is real. The separate employer mechanic is real, and almost nobody at your job is going to walk you through any of this. This is how good earners die broke, not from a stock market crash, from a tax change buried in a 400-page bill that took effect on a Tuesday and silently took $3,600 out of their tax savings in week 1. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees and pre-retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a high-earning 50-something or 60-something who is still working and contributing to a 401k, send them this video today. It could be worth thousands of dollars to them this year alone. And drop me a comment and tell me this. Did your employer or your financial advisor explain the new Roth catch-up mandate to you before 2026 began? Yes or no? I read every single one, and the most common questions become future videos. I will see you in the next.